What's going on, everyone? It's Phil from Millennial Money Gains, and we are back with another video. I want to thank you all for tuning in. And this is a big video because yesterday I actually hit 1,000 subscribers. Thank you. So, what does that mean? I am going to be doing a giveaway, so make sure you look out for that. We're going to do some kind of different giveaway. So look out for that in the next couple of videos as I try to plan that out and figure out what exactly I am doing. But that will be coming, so make sure you hit that subscribe button and turn that notification bell on so you can stay tuned for that. In today's video, we are going to go over trading options on Robinhood. So I know that trading options, for me at least, it was kind of difficult, and even following some YouTubers and videos on YouTube, it's kind of hard to follow along. So I'm going to try to make it as simple as possible. So if you guys are ready for that, hit that like button down below. Make sure it turns blue, as Adam Sandler would say it. Just tap it. Just give it a tappity tap tap, tappity tap tap tap.
Just tap it in. Just tap it in. Give it a little tappy. Tap, tap, tap-a-roo.
So I want to thank you guys for watching, and let's go right into the video. Alright guys, so like I said, we're going to hop right into this video about options. So I have my notes here, and I'm going to try to make this as simple as possible, try not to confuse any of you. So a lot of people say not to purchase options because about 90% of them expire worthless, which is not true. It's only about 30% of them that expire worthless. So what does this mean? You have a 70% chance of them not expiring worthless and a possibility of making extra profit without as much risk. So when you buy options, what it means is you buy one contract for 100 shares. So when you buy one contract, that means you are willing to purchase 100 shares or selling 100 shares. So you need to make sure you have enough money for those 100 shares. So obviously it calls for Apple will be a lot more expensive than calls for a stock that's $10 such as Plug Power. Okay, so we're going to start off first by explaining buying call options. So you usually do this when you are bullish about a stock. Buying calls, you pay the option premium for the contract. So that's a different price depending on the type of call option you will be buying or trying to get the contract for. So if you go into your Robinhood right now and go to trade options and you have options enabled, you can see the different prices. So it would be like 52 cents, which would be $52 because remember you have to buy 100 shares, right? So that would be the premium. And that gives you the right to buy the shares at the strike price. So if the options expire worthless, then all you do is lose that premium that you paid, so the $52 or whatever. So if the stock price goes above the strike price, you have the right, but not the obligation, to buy those shares at the strike price. So some calls you can buy for a week, a month, longer term, 6 months. It really depends on what you are looking at. So for example, you have a stock, we'll say stock X is $10 a share. You are bullish on that stock. You believe it will be going to $11 a share in the next week or so. You put an $11 strike price, and you pay a premium of whatever it is, $50 we'll say, for that right. The stock then goes to $13 per share. You can still purchase that stock at $11 per share because you have that contract. You do not have to, but you can. So that's pretty much all that I have to say about buying calls. It's not as risky as actually purchasing the stock, and the biggest loss you will see is from that premium if your options expire worthless. Alright guys, moving on. Next we are going to go over selling calls. right? And if you guys have any questions about anything, just drop them in the comment section down below, and I'll be sure to answer them. Also, make sure you guys give this video a thumbs up. I can't say that enough, and it really helps the channel out. So, getting right into selling calls. When you sell a call, you must own at least 100 shares of that stock. Remember what I said, one contract equals 100 shares? That means you need to own 100 shares of the stock you want to sell. So this is usually done in flat markets when the market isn't moving too much, if it's not going up or not going down. For an example of selling a call, I own 100 shares of a stock that is trading for $9.50. I would sell a covered call on Robinhood with a strike price of $10. I keep that premium, but would be required to sell that stock, 100 shares of that stock, at $10 if it goes above $10 or not. If it goes above $10, that $10 strike price. If it goes above that, I would be required to sell it at that $10. But I get to keep that premium. So if you don't think a stock is going to move that much, you can sell a call and you keep the premium. And therefore, if the stock goes down or it stays the same, you do not need to sell those shares. But if that stock does, say the stock pops off and goes up to $20 a share, you would be required to sell that to the buyer of the contract for 100 shares at $10 strike price. So they would make a very nice profit on that. So this is a little less risky with less return. But you still have the potential to automatically need to sell a long-term position if that stock does go up past that strike price and the buyer exercises the contract. If the buyer exercises the contract, they will get those shares for $10 a share, even though the stock price may have went up to $20. So you will potentially lose that profit. So that's pretty much all I have to say about selling calls. I think that's pretty self-explanatory. If you guys have any questions, like I said, just leave a comment down below and I will be sure to answer them. Next, we will be talking about buying put options on Robinhood. Okay, so like I said, we're going to be talking about buying put options on Robinhood. But before we do that, I just want to let you guys know, sometimes if it doesn't register the first time, you can play this video back and try to understand exactly what I am trying to tell you. Sometimes after playing it a few times, it will stick with you. So that's just a piece of advice. You want to keep playing this video back in order to understand. Sometimes it will click and eventually you'll get it. Also, if you want to take notes, sometimes writing it out, and I'll try to put some visuals up on the screen, but sometimes writing it out and doing exactly what I'm saying will help you understand more. At least for me, I'm more of a visual learner, so that will help you, hopefully help you understand more about the options. All right, so buying puts. When you buy a put, you pay a premium for the right, but not the obligation, right? So when you're selling calls, you have the obligation to sell that call. You get that premium, but you have that obligation. So when you buy a put, you have to pay the premium for the right to sell. So when you pay the premium, you have the right to sell. When you get the premium, you have the obligation to either sell or buy. Right? So buying a put, you pay a premium for the right to sell at a certain stock at a certain stock strike price. You do this if you are bearish on the market. So for example, if a stock is trading at $10 per share, buying a put with a $9 strike price, the stock price goes down to $8.50, you can exercise that option. If the stock price does not fall below $9, it will expire worthless. So, if say you buy that right to sell the certain stock at a certain strike price, say you buy it for $9, like I said, and the price goes down to $8.50, you can exercise that and sell it at $9. Okay? Rather than the $8.50 that it is trading at right now. So, if the stock price goes up, then you lose that premium and you do not have to exercise that put, so you do not have to buy those shares, but you will lose that premium. So This is, again, less risky because the only risk of losing is that premium, whatever that premium is. It could be $50, it could be up to $1,200, depending on what stock you buy and the length of the option contract that you are buying. So that's really all I have to say about buying puts. And next we will be talking about selling puts. So like I said, if you guys want to try to understand this more, you could play it back and take some notes and try to understand it. That always helps me as I am a visual learner. So let's hop right into selling puts. Alright guys, so when you sell puts, you keep the premium. So the buyer would pay the premium, you get to keep the premium. You don't need to own the shares, but you do need to have enough cash in collateral for those shares. So I'm just going to go over something that I have done with Plug recently, the ticker symbol PLUG. So I started trading, I sold a put. I do not own 100 shares of Plug, by the way. I sold a put on Plug for the stock price was at $13.48 per share. I bought a $13 put strike price and I kept the premium. So it turned out to be like a $50 premium or some sort of that. So I was able to keep that premium. Right now, Plug actually went down a bit. So I needed to have, since I bought that $13 put that expires August 28th, I needed to have $1,300. So I only bought one contract. I needed to have $1,300 in collateral for that put. So that $1,300 went out of my account, but I did not buy the shares yet. It's just for collateral. If that option expires with the stock price above $13, then I get my collateral back, plus I keep that $50 premium. But if the stock price was to fall below $13, which it is right now, I would be obligated to buy 100 shares at $13 per share, which is less than it is trading at right now. So the benefits of this, you can do this for extra income to get the premium if you don't think a stock is going down. Also, if you want to buy a stock at a certain price, but you don't know if it's going to go up or down, you can do this. That way you get the premium. And then if it does go down and you're comfortable buying that stock, you just bought 100 shares of it. So I am comfortable buying Plug at $13 per share. If it does go below that, I will be obligated to buy it. But in the long term, I think it will be much higher than $13 per share. So I get that extra premium. And if the buyer exercises that contract, then I will be obligated to buy that for 100 shares at $13 per share, which is $1,300. So all you need to make sure when you're selling a put is that you have that money in your account at the time you're buying. Otherwise, you will not be allowed to sell the put. So that is all I have to say about selling puts. And that is actually all 4 of the options that we just went over on Robinhood. All right, guys, so I'm just going to close out this video. I want to thank everyone for watching. And also, I want to thank all my subscribers for helping me reach 1,000. Whether you just subscribed or you subscribed from the beginning, it has been a long journey and a lot of work has gone into this. I'm still trying to reach that 4,000 hour of watch time in order to get monetized. And when I do get monetized, I will update you guys on how much I am getting paid and whatnot. So please hit that like button down below. It really helps out the channel. And like I said, if you want to go back and rewatch this video a couple of times just in order to make sure that you understand it fully, you can go and do that. And also take some notes, that really helps. So, as I said in the beginning of the video, I will be doing a giveaway, so stay tuned for that. That will be coming out in the next couple of videos or so. I'm just trying to figure out something cool I can do in order to give back to my subscribers and help you guys out a bit, also while it helps my channel out. So, if you can, just hit the like button down below. Make sure it turns blue. Comment anything you want to see, any specific stocks you want me to go over. And I'll see you guys in the next video. Make sure you hit that subscribe button as well, as we will be posting 2 videos per week. And I am making that commitment to you guys now. I will be posting 2 videos per week. And if I cannot do that, I will tell you guys in advance. So, thank you guys for watching, and I will see you in the next video. Peace.